Good morning, everyone. So, I think in the last session we had commenced this new standard, India's 113, that deals with fair value measurement. So, we saw exactly what do we mean by fair value, uh, which basically involves an exit price, that is the price that you would get on sale of an asset or you would pay to transfer a liability in a transaction between market participants, in an orderly transaction between market participants at the measurement date in an appropriate market. This was the definition that we had. And when we were discussing this, we saw that appropriate market covers two types of markets. One is a principal market and the other is the most advantageous market. So principal market where you have maximum buyers, sellers and maximum transactions. So price tends to move towards fair value, whereas most advantageous market, the standard takes a rational view that an entity will obviously prefer to sell its products in a market where it benefits the company to the maximum. So when I have to look at the most appropriate market, my first preference will be to the principal market. If principal market doesn't exist, which happens in most of the cases, then we move to the most advantageous market. Then we saw what exactly is most advantageous market, which maximizes your net proceeds, which is nothing but market price minus transportation cost minus transaction cost. And we saw that fair value is market price minus your transportation cost. That is essentially the cost required to bring the goods to the marketplace. Okay, so this is broadly what we had discussed in the previous session. So now what we will be covering up today is valuation of non-financial assets. And then we move on to your valuation hierarchy and valuation techniques and principles. With that, I think we should be in a position to close the standard at the end of today's discussion. Okay. Now see, valuation of non-financial assets. See, we have two categories of assets. One is non-financial assets and the other is financial assets. So what are financial assets? Financial assets, basically they become your securities. Okay, in a very simple term, though you have a very big definition for financial assets, for today, they broadly fall like they would broadly include items like your securities, shares, debentures, bonds, zero coupon bonds, etc., etc. Okay. Again, I'm not going into the technicalities of financial assets. But the key point that we should take away from here is financial assets have a very specific use. You hold investment in bonds to collect interest and on maturity the principal. So very simple. You hold debentures also for the same thing. I mean, you have your debentures also for the same thing. That is, you issue debentures, you pay interest, and you finally pay out the debenture principal as well. Okay. Similarly, you are also having investment in shares. Shares could be if they are subsidiaries, then you are holding them for activity, or you could probably engage in holding of shares for the purposes of uh, trading or such kind of activities. So they come with, or even for getting dividends, for capital appreciation and dividends. So these are identified uses of financial assets. So therefore, the predictive value of returns that you get from financial assets, barring market appreciations, is very high. So you know what interest your bonds will fetch, your debentures that you hold will fetch. So the predictive value of these returns is very high. Market price, of course, fluctuates. That is not within our control. But the intention behind holding a financial asset is to get this passive income. That is one of the critical reasons. Now, when we come to non-financial assets, the matter slightly differs. Non-financial assets, we don't have a single usage like how we have for financial assets. Okay. And because of the fact that there is no usage confined to a particular methodology, the valuation of non-financial assets becomes more difficult. Tell me one thing, when we talk about fair value, this is from the perspective of an entity or from the perspective of a market participant? What do you think? Fair value is from whose perspective?
Market perspective.
Market perspective, absolutely. We saw this in the last class. Okay. So it is always from the perspective of the market. So therefore, even the definition it says it is a transaction between market participants. Okay. So when you have an asset, the utility of that asset should be viewed from a market perspective and not from an entity perspective. Let us understand with the help of an example. Okay. I have land parcel. I have a land parcel. Okay. Now on that land parcel, what all activities can be done? What all activities can be done? Put your thinking caps and tell, on a land parcel, what can I do? You have vacant land.
Build a building.
You can construct a residential complex, or you can construct a commercial complex, or
Yes.
you can give the empty land as a rent. You can convert it into a parking space. You can leave it idle. That is also one manner of use, capital appreciation. You can construct a hotel on that, yes, and use it for your business operations. You can, if it is big enough, you can construct an amusement park, yes, or XYZ. The uses are endless. The uses are endless. You can do anything and everything that you want on that land. If it is in an industrial area, you can build a factory. Yes. So the uses are enormous. The uses possibilities are enormous, what you can use it. Now, when we talk about a fair value of this asset, when we talk about evaluating the fair value of this asset, you tell me which of these will you consider? Which of these will you consider for the purposes of fair value? See, I am an owner of land and I specialize in residential complexes. So I have a limitation that I cannot build commercial complexes or hotels or resorts or amusement parks, etc. Does it mean that the fair value of the land is only equivalent to the residential complex construction value of it? Or should I take a market participant overview in it?
Market participant.
Market participant. But now market participant overview is having so many possibilities. On fingers, I counted 6 to 7 possibilities. In reality, it can even extend. If it is a huge parcel, I can construct a stadium. If it is a huge parcel, I can construct a Formula One racing track. If it is a huge parcel, I can construct a big theater on that, right? So the point is, there is no end to this. Now, you tell me what will be the basis for determining the market value? Because uses are multiple, and with multiple uses, the value of the land also will keep on varying. Yes, commercial complex may fetch a particular rate, amusement park may fetch a particular rate, hotels may fetch a particular rate. Do nothing, you construct a huge convention center. Like if it is in Delhi, you have that Bharat Mandapam, right? You can construct a Bharat Mandapam or that is one convention center. Or if you are in Mumbai, you must have seen or heard about Geo Convention Center in BKC, right? So I could do that also. Yes. So the possibilities are endless. The possibilities are endless. Now, each possibility has a value. So obviously, as a preparer of financial statements, you cannot expect me to evaluate each and every possibility. Okay. So what the standard tells is whenever we have to evaluate non-financial assets, we will use something known as highest and best use concept. We will use something known as highest and best use concept. What does it mean? It is a valuation concept that is used to value many non-financial assets. When we talk about highest and best use concept, it must be that use which is having three key possibilities. It should be physically possible, it should be legally permissible, and it should be financially feasible. All these three categories, all these three conditions must be fulfilled for the purpose of evaluating that particular use. Physically possible. Suppose I have a parcel of land which is about 25,000 square meters, or that is 250,000 square feet. That is a huge parcel of land, huge parcel. Usme you can even probably have stadiums, you can even have amusement parks, you can even construct amusement parks. It is physically possible. But suppose your parcel of land is not 200 and is not 25,000 square meters, but instead it is 2,500 square meters. 2,500 square meters is 25,000 square feet. Reasonably good, supports residential construction, but obviously you cannot build a stadium over 2,500 square meters. You cannot build an amusement park over 2,500 square meters of area. So it is not physically possible. It is not physically possible. Legally permissible. You have land which is agricultural land. Conversion has not happened to settlement zone or to non-agricultural land. That means, is construction permitted on that? Answer is no. So when construction is not permitted, the question of evaluating that land for the purposes of residential, commercial complex, etc., all of that is not possible only. Legally, it is not possible. And therefore, you will not consider those values. You will only see what is legally permissible agricultural land. So you will look at the rate for agricultural land, and that becomes your basis for valuation. And finally, it should be financially feasible. Finally, it should be financially feasible. So all these three things have to be met. Okay. The highest and best use is determined from market participant perspective. I told you, I may not be in the business of constructing and managing stadium, but if that is the highest and best use, you will consider that for the purposes of evaluating your highest and best use. Okay. It does not matter whether the entity intends to use the asset differently. Here you are evaluating the fair value. You may use it for something else, but you will have to evaluate the fair value depending on what the highest and best use is. To find out the best possible use, identify the market participants, and then to find the best legitimate use of this non-financial asset, which one would normally do. That is very simple. All restrictions specific to any market participant would not be considered. Entity specific restrictions, whether me or somebody else, they will not be considered. Yes, while finding out fair value of the non-financial asset. In absence of potential best use, which is not easily available, the current use would be considered the best use. Okay. Potential use is there, but not easily available. Then current use is considered as the best use because it is rational for any entity that any asset that it owns, it is using it to the best of its capacity. Okay, to the best of that asset's capacity. So it is the best use. That means this particular category or this particular line is something which is most more often taken shelter to by the companies for non-financial assets. If I have kept it idle, maybe that is the best use, right? Because capital appreciation of that land makes it more and more valuable, makes it more and more valuable. While considering fair value under any alternative use, deduct the estimated cost to be incurred in order to make the asset ready for alternative use. So what does it mean? It means that suppose I have land. On that land, there is some old structure. The highest and best use is construction of a commercial complex. Now, I cannot construct a commercial complex on land where there is an old structure. I will have to demolish that old structure. I will have to demolish the old structure. So, when I am determining the fair value of this land, it's not only the fair value for the commercial construction purposes, but from that I will have to deduct the demolition cost, because until I demolish, it will not become usable for commercial construction. Are you able to follow? Yes? Are we able to follow?
Yes.
Yes. Any doubts so far on the highest and best use concept? Anybody has any doubts? Yes. Okay. So today we have the full team. Swaminathan is back. Geeta is there. Sanjay, Bibu, Leela were always there. Okay, fine. Any doubts so far on valuation of non-financial assets, the highest and best use concept? No doubts, then we can proceed further. Okay, yeah. So typically, so Swaminathan has just written down that we use to value biological assets at fair value, less cost to sell. That's right. In the Ind AS 41. That's right. Okay. All right. Fine. No doubts. Shall we proceed further then? All right. Fine. Okay. Example 11. Same thing what we discussed. Entity bought some land intended to be used for business purposes. However, it now wants to sell this piece of land at its fair value. So you evaluate all possible use. You could use to make a commercial place which could be more in value as compared to when it is used for business purposes. So commercial place value would be considered the highest and best use if it is allowed in the near location and conditions. Okay, so fair enough what we have discussed. Current use as highest and best use. A Limited acquires a machine in a business combination by acquiring a controlling stake in B Limited. It has purchased a machine pursuant to a business combination. Okay. Acquired a machine. The machine will be held and used in A's operations. Machine was originally purchased by B from an outside vendor, and before the business combination was customized by B for use in its operations. However, customization of the machine wasn't extensive. A determines that the asset would provide maximum value to market participants through its use in combination with other assets or with other assets and liabilities, as installed or otherwise configured for use. There is no evidence to suggest that the current use of the machine is not its highest and best use. When you buy a machine, what is the reason you buy a machine? Why do you buy a machine?
For production.
For production. That's right. So, you intend to put that machine, install it in your factory or whatever production area, and you want to use that machine to produce or manufacture something over the next couple of years, as long as the machine functions perfectly fine. And this is the way you get economic benefit from that machine. Now, buying that machine, you don't do that for selling it, right? You believe that buying that machine will probably give me more and more revenue. So therefore, that becomes the highest and best use for this particular entity, owning and operating the machine. And it is a rational entity. It will do something which is always business-wise rational, And the rationality requires us to understand that usage of the machine for the manufacturing activity is the best use that is possible, and therefore that will be considered. Are we able to understand? Yes. Are we able to follow?
Yes, sir.
Yes.
Yes. All right. Fine. Okay. Potential use as highest and best use. Okay. A Limited owns a property which comprises land with an old warehouse on it. It has been determined that the land could be redeveloped into a leisure park. The land's market value would be higher if redeveloped than the market value under its current use. A Limited is unclear about whether the investment property's fair value should be based on the market value of the property under its current use or the land's potential market value if the leisure park redevelopment occurred. Now, anybody from Mumbai surrounding areas? Anybody from Delhi surrounding areas?
Yes.
Okay, fine. So I think we had discussed this previously, but I'm still bringing it up. So 20 years ago or 10 years ago, land surrounding the new Noida airport, was it factoring the airport construction that would happen?
No.
No. But now if you go to that particular place, then the unique selling proposition of that land is what? Sir, ये airport के नजदीक आ रहा है, नया airport आ रहा है. Am I right?
Yes.
And
Jewel
that has
Airport.
increased the valuation of the land there at least by 6 to 10 times, if I'm not wrong. Correct?
Correct. Correct.
So there is a potential infrastructure development that is happening, which is giving rise to a increase in fair valuation. And therefore, these factors, now 10 years ago, nobody knew that surrounding land would get so much of value. But today, because there is something which is legally permitted, we have an infrastructure that is coming up in that particular place, it has in turn increased the fair value of this land. Now, in this particular example, you have a property where there is an old warehouse, and this particular parcel of land could be redeveloped into a leisure park. Okay. So therefore, when I have to evaluate the potential of this land, I will have to factor the fact that the potential construction could occur. Okay. In Mumbai, you have those old mill areas. Okay, in surrounding. Nobody from Mumbai, yeah, from here. Geeta,
Mumbai, sir.
Mumbai. तो आपको पता होगा लोअर परेल उस एरिया में you have old mills which are dilapidated, जो मतलब अभी यूज में नहीं है.
Yes, sir.
Right?
They are now being redeveloped or rethink to something new.
Correct. They are being developed into commercial spaces, right? Probably. Okay. वहां पे you have all these kind of peninsula business park and etc. वो सारी चीजें थी. So surrounding those areas you have certain mill areas जो पुराने जमाने में mills होते थे where industries workers used to come and carry out activities in those mills. Today those mills are idle. They don't have any activity. वो पूरा मतलब it is in ruins. But the land is precious. That is one of the most prime areas in and around Mumbai in South Bombay, right? So therefore, today when I have that mill land on which I have old mill structures, Today, it is a gold mine for real estate developers to construct any commercial property. So, the owner of that mill land, what is he going to consider? Will he consider the mill as the highest and best use, which is not in any shape right now? Or will he consider the fact that this land be uh, can have this land has the potential to have a commercial high rise coming up, and therefore that will be the basis for determining the fair value? Yes or no?
So they
Yes.
will consider the industrial high rise, commercial high rise in the price of.
Commercial high rise, exactly. Commercial high rise, because अभी वो mill land समझेंगे तो it will not fetch a high value. So you will look at the potential use as the highest and best use. So the property's fair value is to be based on the land's market value for its potential use. Highest and best use is the most appropriate model. Under this approach, the property's existing use value is not the only basis considered. Fair value is the highest value determined from market evidence by considering any other use which is physically possible, legally permissible, financially feasible. All these three things you will have to consider. The highest and best use valuation assumes the site redevelopment, so which will involve demolishing the current warehouse and constructing a leisure park in its place. Therefore, none of the market value obtained for the land should be allocated to the building. So the market value of the current building on the property's highest and best use as a warehouse is nil. As a result, building's current carrying amount should be written to zero. Because उसमें कुछ मिलेगा नहीं. Or are we able to understand? Yes.
Yes.
Swaminathan, did you follow?
The last one I did not understand. Is it why
See,
nil?
see, I have land plus building on that, correct? Now, this land plus building has an alternative use involving construction of a leisure park. Correct? Correct?
Okay,
So,
I understood. The warehouse value is nil, not the land.
yes, so this has to go. The warehouse has to go. So, this value is nil. Land cannot be nil. Okay? Land cannot be nil. When this goes, I can use the land for the leisure park. Are we able to follow?
Yes, yes.
Yes. All
Absolutely.
right. Next. ठीक है. Mm, I leave this to you for homework. It's based on similar grounds. All right. So I leave this for homework or end of today's class. Maybe if we have time, we can revisit this. Okay. So that is all that we have on the non-financial valuation of non-financial assets. Any doubts so far? Anyone? Or do one thing, go through this question right now because we are about to start up on the next method, on the next topic. So go through this question and give me your answers. It's a simple question.
Yes, the highest and best use of the land would be from the residential side building of the apartment, high-rise apartments.
Yes. Others?
Sir, high rise residential side.
High-rise residential will
Thank
be
you.
the, okay. Girls, Leela, Geeta, high rise value, Swaminathan has confirmed. Yes. Okay. All right. See, Company J acquires land in a business combination. Land is currently developed for industrial use as a factory site. Although the land's current use is presumed to be the highest and best, J considers the fact that nearby sites have been developed for residential use as high-rise apartment buildings. On the basis of that development and recent zoning, etc., J determines that the land currently used as a factory site could be developed as a residential site. And the market participants would take into account the potential to develop the site for residential use when pricing the land. Determine the highest and best use. So highest and best use will be a trade-off between two uses. Usage as a factory site, or second one is high-rise building. Second one is high-rise building. So when I will have to evaluate, the fair value, obviously you will consider for sure you will be considering for sure the fact that what is the value of this land if I use it for a high rise building. But at the same time, currently it is suited for industrial use. So you will just do an evaluation of that particular proposition. How is it for the current industrial use? And then you will arrive at a decision. It is just saying that there is an alternative use that is available. So we'll explore that and arrive at the decision. Typically, high-rise buildings do have higher value, no denying that. But when you're doing a trade-off, it involves multiple factors. So by constructing as a high-rise, you will lose out on the industrial value here. You will lose out on the cash flows that you could get. Then for that purpose, you will accordingly make a decision. Okay, so our temptation is to say high rise is very good, but probably in all fairness, industrial use also could be very high, right? Industrial use also could be high. So suppose in an area like MIDC in Andheri, there is an area called Seeps. Oh, all right. So in Seeps, you construct a residential complex in the SEZ area. Who will come and stay there? Instead, if you construct a factory or such kind of a structure, then all SEZ benefits will flow to that place, right? You will save up on taxes, compliance becomes easier, and therefore that will end up becoming the highest and best use. Okay, so that is how you can evaluate. But anyways, what you guys said is not fully incorrect. Okay, so that covers this question. All right, any doubt so far? All right, so all right, that's correct, Swami. Okay, all right, fine. So that is done. Leela, Geeta, Vibhu, Sanjay, all clear?
Yes, sir. So both the answers we have to write, sir.
You will have to mention both because in this question they have not given, right? Have they given that this is highest? They have said potential exists, right?
Yes, sir.
So, see, the beauty of our profession is we can justify both the things. Okay. So, your answers should depict the fact that you have understood the propositions correctly. Okay. Yes, our first temptation would be to yield and say that high-rise building is the highest and best use. But it need not be the case always, right?
Yes.
So, so that is the thought process which typically comes through. Okay, all right. Now we come to the next part, that is valuation techniques. We come to the next part, that is valuation techniques. Okay. All right, fine. Now, when we talk about fair value, so far whatever we have read, has the standard prescribed any formula to calculate fair value? Answer is no. Has it given any assumption? Answer is no. It has given you principles. One of that we just now saw, highest and best use. So therefore, it is a principle-based standard. And when we look at fair value, you tell me, what would you regard as a fair value? The fair value is something which should be comparable to a market value, right? Market value minus transportation cost, ठीक है, but there should be a key ingredient, that is comparison with the market value. Yes or no? Yes.
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 So therefore, suppose I have one share of Reliance held with me. How can I calculate the fair value of this share? Tell me.
The market value on the stock exchanges.
Market value on the stock exchange is one method. But technically, you people have studied financial management, right?
Yes.
I think in that you have valuation of securities as one topic. We had it.
Yes.
All
Yes.
right. So when you have valuation of securities as one topic, you remember there is this Gordon's formula.
Yes.
Yes. Gordon's formula में आप क्या करते थे? Present value of future cash flows.
Yes.
And you would calculate something known as a terminal value at the end of 5 years.
Yes, sir.
उसको डिस्काउंट करके प्रेजेंट वैल्यू में लाते थे. Yes. So can I do that activity for Reliance? If I get all the data, Reliance plans to set this factory there, that company there, that Geo thing there, AI there, XYZ. If I have all that data available with me, can I myself calculate the discounted cash flow value of this particular security? Bolo yaar.
Yes, sir, we can do
Yes.
that, sir.
You can do that, no? Everybody, Sanjay, Bibu,
Yes,
Leela,
sir.
can we do that?
Yes, sir.
Yes. So you will get another value. Now you tell me, as an independent party, which value will you be considering? Will you be considering the long drawn process of assuming, evaluating, calculating, questioning, and arriving at the fair value under the DCF method? Or will you just go to the stock exchange, acha, NSE, BSE, this is the traded price and that is the fair value? Which would you prefer?
Sir,
Stock
firstly,
exchange.
we would prefer the stock exchange.
You would
Market
prefer the
price.
stock exchange value. What about Sanjay? You were telling something?
Yeah, stock exchange price, I was telling.
Stock exchange
Market
price.
value. Yes.
Market
Yes, sir.
valuation. What is the reason you prefer this?
This is the quickest and shortest method.
Okay, quickest and shortest. I think there is one more thing which you are preferring it for, but maybe you are not able to tell it. Vibhu, you would like to say something? Leela? Yeah, Vibhu, tell me. Yeah, go ahead. See, why did we want the why do we prefer the stock market value? I can see it. I don't have to decide anything. उधर से value लिया, that becomes my fair value. It is a very, very objective method of evaluating. It is like your MCQ. MCQ देख, क्वेश्चन देखा, MCQ टिक कर दिया, आंसर इज yes or no. Correct?
Yes.
But if I look at the DCF method, does it involve assumptions? Yes.
Yes, sir. It will involve assumption. The saying that the dividend will be paid.
10 assumptions will be there
Yeah.
in that.
Yeah,
Future profitability, future cash flows, discount rate, risk factor, all this will be considered. So a DCF valuation today, if Swaminathan calculates, tomorrow if Leela calculates, day after tomorrow if Geeta calculates, will it be same for all of you or will it be different for all of you?
It will be different, sir.
It
The
will be
assumption will
different
be
on
vary.
the basis of assumptions made from others.
Yes, my assumptions will differ from others. So then वो fair का fair कैसे हो गया? It becomes a value or specific value, right? I'm not saying you guys are wrong. I'm not saying that what Leela calculates the fair value is incorrect, what Swami calculates is correct. I'm not saying that. Leela has put in her assumptions and calculated. So she got a particular value. Swaminathan has got a particular value. Both are correct. Both assumptions are reasonable. But that is the problem. You assume. Valuation techniques tell that, or the golden rule of valuation tells that you should consider that fair valuation mechanism which maximizes the use of observable inputs. The stock market value is an observable input. आप उसका वैल्यू देख सकते हो स्टॉक मार्केट पे. You do not have to do anything. You just go look at the value, put it as your fair value. You don't have to do anything. So I want to arrive at a fair value by maximizing the use of observable inputs and minimize the use of unobservable inputs. जो DCF calculation था, for Leela, you got a separate answer. For Geeta, you will get a separate answer. For Manish, you will get a separate answer. Bibu will get separate. I have 6 people here. I will get 6 different fair values. All of them are correct in their own way. But they are using which inputs? They are using unobservable inputs. Leela may take a different discount rate from Geeta. Geeta may take a different cash inflow assumption compared to Sanjay. Sanjay may take a different increment approach after the terminal value period from Bibu. Bibu may take something different. Bibu may say, my terminal value I will take from year 7. Swaminathan will say, I'll take terminal value from year 5. So all these assumptions are based on unobservable inputs. What do you mean unobservable inputs? It means that these are inherently assumed by
Recording stopped. Recording in progress.
Okay. These are particularly specific to the people who have done the fair valuation. You cannot validate it with something which is freely available in the market space. Are we able to follow? Yes?
Yes.
Yes or no?
Yes.
So therefore, to be very honest, the only rule that is prescribed in Ind AS 113 is you will use a valuation technique. Maximizing the use of observable inputs and minimizing the use of unobservable inputs. पूरा minimize नहीं हो सकता. You cannot minimize it in totality. Okay. For example, let us take Kia company, right? You know Kia, 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 सबको पता है?
Yes. Car manufacturing.
Car manufacturer, right? A Korean-based car manufacturing company which is there in India. Kia's shares are unlisted. Okay, Kia's shares are unlisted. So will you have an observable input?
No.
No. Leela, Geeta, clear? No observable input.
Yes,
So
sir.
I have two things available with me. First one, I go for a DCF valuation, in which I will ask for Kia's financials, their assumptions, their growth model, their forecasted P&L for the next 6 to 8 years, and how they will progress. All this XYZ you will carry out. All this XYZ you will carry out. Put a suitable discounting rate, bring it to the present value, divide by number of shares, your per share value becomes so much. This is one way of doing. Okay. All right. Second way of doing. Kia is closely similar to Hyundai. Correct? Hyundai is a listed company. Yes or no? So
Yes.
can I take the listed value of Hyundai's shares and apply it to Kia? Answer is no. Sir, वो तो Hyundai का value है. That is Hyundai's value. How can you apply it to Kia? No, you cannot. But can I take Hyundai's value and do some adjustment? For example, liquidity adjustment. Yes. What do you mean by liquidity adjustment? Well, Hyundai shares are listed. So therefore, it will be freely buyable and sellable in the market. There is a market for that. But Kia shares are not saleable. Kia shares are not saleable. And therefore, they are not liquid also. You will have to make effort to sell your stock. You will have to make effort to sell the stocks in Kia. And therefore, there is a liquidity risk attached to that. So if I take the share price of Hyundai, do the liquidity risk adjustment for Kia, assuming this is the only adjustment, can I say that this will also give another fair value of Kia shares? Yes or no?
Yes.
Yes,
Manish, Geeta, are you able to follow?
yes, sir.
Leela, you are able to follow?
Yes.
Okay. All right. Able to follow. Okay. So therefore, is that also another way I can determine the fair value? Answer is yes. Now, between these two, DCF and the second method, which method would you prefer for fair valuation? Tell me.
Second one.
Okay, second one. What about others?
Hyundai, sir.
Second one, Hyundai. Leela?
Yes, second.
Yes, second one. Okay. Obviously, because the second method already captures the fair value sentiments of the car market in general for a Hyundai vehicle. And after capturing those sentiments, I will adjust it for certain specific features of Kia, one of which includes liquidity risk, to arrive at your fair value for Kia's shares. Fair value for Kia shares. So the basic premise is you want to maximize the use of observable inputs, because when I maximize the use of observable inputs, judgment that I do, judgmental calls that I take gets reduced. Okay. And minimizing the use of unobservable inputs. Minimizing the use of unobservable inputs. Okay. So that is what is the fundamental or golden rule that is there. Okay. So observable input means what? Based on market data obtained from independent sources. That is your BSE or gold rate on commodity exchange, etc., etc. And unobservable inputs based on entities' own assumptions about financial factors, on entities' own assumptions based on projected future cash flows. Okay. All right. So that is your observable and unobservable. So in the same breath, your observable, unobservable inputs, what we saw, they are categorized into 3 levels. Okay, into 3 levels, which we call popularly as the fair value hierarchy, which we call as the fair value hierarchy. These are level 1, level 2, level 3 inputs. Okay, level 1 inputs, you are owning Reliance shares. You want the fair value. कैसे करोगे? You will look at the fair value at the particular date you want, copy paste it. No adjustment needed. No adjustment needed. Okay. Quoted prices in active markets for identical assets or liabilities. For identical assets or liabilities that the entity can access at the measurement date. Which assets are they talking? Identical assets. Identical assets. Say similar भी नहीं बोल रहा है वो. It is talking specifically that it is the value for identical asset. So typically, where do we use this? Share prices on the Bombay Stock Exchange or National Stock Exchange. Or if you are holding gold, then quoted price of gold held as an investment. Are we okay with this? Yes.
Yes, sir. Yes.
Any doubts? No doubts? Okay, fine. Level 2 inputs. Level 2 inputs, we saw that Kia example, right? Take Hyundai's price, do some adjustments to arrive at fair value. Inputs other than quoted prices included within level 1 that are observable for the asset or liability directly or indirectly. Directly or indirectly. These inputs include quoted prices for similar assets or liabilities requiring certain adjustment. For example, gold. I know the market value of 24 carat, but I have a 22 carat gold, right? So I can adjust it. Take the market value of 24 carat gold, divide by 24 multiplied by 22. That gives you the value of your 22 carat gold. Are we able to follow this?
Yes.
Yes. We call this as level 2 inputs. We call this as level 2 inputs. And finally, you have level 3, which is unobservable inputs, which shall reflect assumptions that market participants would use when pricing the asset or a liability. Example, financial forecasts, volatility required for valuing options under the Black-Scholes model, etc. Okay, so there is a lot of judgment, a lot of a lot of judgment, a lot of estimates which are involved in level 3. It is not saying level 3 is bad. It is saying level 3 is not preferred when level 1 exists. Level 1, level 2 nahi hai. You have to fall back to level 3. There is no choice for you. Okay, there is no choice for you. If you are doing impairment testing of your machinery and you have to determine the fair value, do you think machineries are quoted on some market? Answer is no. You will have to look at level 2 or level 3 only. There is no other option available. Okay. All right. Fine. Next. We then move further on the principles. If an observable input requires an adjustment using an unobservable input, and that adjustment results in a significantly higher or lower fair value measurement, the resulting measurement would be categorized within level 3 of the fair value hierarchy. Okay, it would be categorized within level 3 of the fair value hierarchy. So, I have observable input, but because of certain information, I will have to do certain adjustment. To that. And by virtue of that adjustment, there is a significantly high or low fair value measurement, which you have to consider. That fair value measurement becomes a level 3 fair value hierarchy. Are we able to follow? Are we able to follow?
Yes.
Yes. Yes. It moves directly from level 1 to level 3. Now, significantly not defined. Kitna 10% of fair value, 20% of fair value, 100% of fair value, 200% of fair value. None of this is defined. None of this is defined. Okay. What is significant? So this is where the standard gives you the principles. You will have to evaluate and apply what it is. Okay. All right. If a market participant would take into account the effect of a restriction on the sale of an asset when estimating the price for the asset, an entity would adjust the quoted price to reflect the effect of that restriction. If that quoted price is a level 2 input and the adjustment is an unobservable input, the measurement would be categorized within level 3. Level 1 to 3 भी जा सकते हो, 2 से 3 भी जा सकते हो. Anything is fine. Okay. All right. Fine. Any doubts? Who does the valuation for other than observable inputs? That's right. So it is the registered valuer. Normally that is how it is handled. Okay. Who does the valuation for other than observable inputs? Yeah, it is the registered valuer. For example, land, you have investment properties and there is a requirement to disclose the fair value of investment property. So you can go to a registered valuer in the asset class of land and tell him this is the location, this is the area, this is the measurements of the land, this is the survey number, etc., etc. He will go there, look at surrounding areas, look at the vicinity, look for any recent buy-sell transactions which have happened, and then he will give his opinion, which becomes a level 3 hierarchy, Okay, because he's on a level 2 hierarchy, he looks at vicinity and then he does the adjustment for the land that you are owning. Are we okay with this?
Yes.
Okay. Now, based on this, read this question right now, 18, example 18. Understood 18?
Yes.
Yes,
Yes.
sir.
All right. Quite simple, similar to what we have covered. Example 20. There is a receive fixed pay variable interest rate swap. You people would have studied swaps, right? Or you will study probably. Okay. Based on a yield curve denominated in a foreign currency. Okay. So typically you have instruments which are, you have certain borrowings where interest rate is fixed or interest rate could be variable. Many times what happens, suppose I have taken an instrument which has a fixed rate of interest, and let us suppose Manish has taken an instrument which is having a variable rate of interest. Now, I think that interest rates will go down in future. Fine. Manish thinks interest rates will go up in future. अभी दोनों opposite हो गए. Opposites attract each other. So I go to Manish, Manish comes to me, and then I tell him, look, I have this fixed interest instrument. Let us exchange the interest let us exchange the interest component. You give me the variable component and you take my fixed component. You give me the variable component and you take my fixed component. Are we able to follow? Yes. This is an interest swap. This is an interest swap. Now, this interest swap was based on a yield curve denominated in a foreign currency of 11 years. Okay. However, the market data that you have is only for a period of 10 years. 11th year के लिए कुछ है नहीं. So the rate for 11 years can be established using extrapolation or some other techniques based on 10 years available rates of swap. The fair value of 11 years so derived would be your level 2 fair value. Are we able to follow? They need 11-year rate swap, but market data available is only 10 years. So you will have to do an extrapolation for 1 year. Are we able to follow? Sanjay?
Yes.
It's just an example to make you conversant with level 1, level 2, level 3. Okay. All right. An entity has an investment in another entity which has no active market. However, some similar investment is being traded in an active market. Now the fair valuation can be done based on either the prices based on the market which is not active or similar traded investment in an active market. This would be considered as level 2 inputs. Okay, so fair enough. All right. Fine. Okay. Interesting. Now, let us suppose right. 31st March 2025. Let us suppose that you have invested, or let us suppose you are a company like Tata Advanced Systems Limited. I don't know whether this is quoted or not. Or L&T Defense. L&T, they call it as precision engineering. Okay. These are listed entities. These are listed entities. Okay. So if they are listed entities, they will have their market value. Yes or no?
Yes.
Okay. So 31st March closing value. Let us suppose it is 2000 rupees. What time do markets close?
3:30.
3:30. So this is your value at 3:30 p.m. on 31st March 25. Okay. What had happened in the meanwhile was the company had given bid. These are into strategic defense areas. Okay. These are into strategic defense areas where they provide components to the government, to defense research organizations, and even with big aircraft players like Boeing and Airbus, etc. They provide major components. In fact, you would be aware that Tata is now one of the key suppliers for Airbus in India. And they're coming up with probably a plant that will be established in and around Hyderabad region, right? So I think they have something that is being set up there or is already set up there. Okay. Now, let us suppose Tata Advanced Systems had given a proposal to Airbus to manufacture aircraft wings. Wings होते हैं ना जो aircraft के दोनों side होते हैं. That is a very critical and crucial component for aircraft. Without that, aircrafts can't fly. So in Q3, Tata's had informed that we have given a proposal to Airbus. Okay, Airbus had invited bids. Tata had given that. Those bids and discussions, they get opened at 4 p.m. on 31st March 2025 at 4 p.m. By 6 p.m., your entire due diligence process in respect of those bids is closed, proposal is closed, and by 6:30 p.m., Airbus comes with an announcement. Tatas are our new partners, and Tata Advanced Systems is now going to provide wings and other crucial aircraft parts to Airbus India. Yes, when did the announcement come? 6:30 p.m. on 31st March 2025. Yes or no? Yes or no?
Yes.
So now, is it a major win for the company?
Yes.
Yes. If it is a major win for the company, would this have been visible in the market price?
Yes, sir.
Yes. But is it visible in the market price as on 31st March 2025?
No.
No, because
No, sir.
markets closing के बाद you are getting this information. Yes or no?
Right. Yes.
When will the markets react to this news?
Next day.
Next.
Stay.
Opening rate or closing rate?
Opening rate.
Opening rate. So on 1st April 25, the opening rate will not be equal to the closing rate. It generally doesn't be, but here the variation will be huge. Here the variation will be huge. Now you tell me, suppose you are an entity in holding one share of Tata Advanced Systems. You are holding one share of Tata Advanced Systems. Which value are you going to take when you are closing the books on 31st March 25? Which valuation are you going to take? Are you going to take 31st March value, because that is the only written value which is available, or will you take the 1st April value and put it as your value at 31st March 25? Are you going to do this? What are you going to do?
Sir, I will use the 1st April opening value as a closing value of 31st March.
Yes. What about others?
Yes. I will do the same because this is the subsequent event.
Yes.
And it is adjustable.
Vibhu, Manish,
Same, sir.
agreed. Okay. Girls, Geeta and Leela.
Yes, agree.
Yes, sir.
So now you tell me, will this become an observable input? On 31st March, you are putting opening value of 1st April. So is this an observable input?
No.
Yes or no?
No.
No. What about others? Is this an observable input? Swaminathan also says it isn't. What about the girls? It is not an observable input, because if a reader of financial statements looks at the balance sheet where Tata Advanced Systems share is shown, and when he looks at the stock exchange price on 31st March, the values are not same. The values are not same. And therefore, what will be the same valuation input? You cannot say it is observable. You are going to say that it is an unobservable input. You cannot take it as a level 1 measurement. You cannot take it as a level 1 measurement. A company's valuation policies and procedures should address how these after hour events will be controlled and identified. Controls should be put in place to ensure any adjustments made to quoted prices are appropriate and are applied in a consistent manner. Are we okay with this? Yes.
Yes.
All right. I want you to go through this question right now. Okay. Go through this question right now. Just give me a have you gone through?
Yes, done.
Same question? Same
Yes,
like
please.
the example that we discussed?
Yes.
Only thing is this is a pharma or some biotech company, right? And this is a negative information. I started with something positive. This question has the opposite. Okay. So a failed clinical trial, which was announced after the trade date. So you are taking the price of 22.5 and it will be an unobservable input. So everybody understood, I hope. Okay. All right. We move further. Yes. Now when we look at valuation techniques, there are three approaches which are there. The market approach, the income approach, the cost or asset approach. Market approach, look at the market value, give your, take that as the fair value. It is generated by market transactions involving identical or comparable assets. So level 1 and level 2 inputs. Typically, these are the market approaches. You can also use market multiples derived from a set of comparable companies. Example, EV, EBITDA multiple, PE multiple, etc., etc. Okay. So that is a very simple manner of valuation. Level 1, level 2 inputs would typically have something known as the market approach inbuilt in it. Income approach, DCF method, converts future amounts to a single current amount, like Gordon's formula. Assumption of future cash flows and appropriate discount rate would be based on market participants' views. Risks and uncertainty to be considered would be taken in the cash flow or in the discount rate. Tell me, income approach is for level 1, level 2, level 3 inputs. Which one?
Level
Yes.
3 or 2?
Level 3. This is level 3. Typically, markets will be level 1 and level 2 inputs. This is entirely unobservable. You can't observe. It's all based on your estimates. So this is level 3 inputs. Level 3 inputs. Okay. Cost or asset approach. This method describes how much cost is required to replace existing asset or liability to make it in a working condition. And all the related cost will be its fair value. It actually considers replacement cost of the asset or liability. For valuing a business or share, it may be the NAV. Valuation approach to be consistently followed. If there is a change in valuation approach, treat it as a change in accounting estimate. That is, disclose the reason for the change, but no prior restatement. Okay, so that gives you your answer. All right. Now, we come to certain questions. Oh. All right. Come to this question, illustration 2. Investment 1 is a contractual right to receive 800 in 1 year. There is an established market for comparable assets and information about those assets is available. Of those comparable assets, investment 2 is a contractual right to receive 1200 in 1 year and has a market price of 1083. Investment 3 is a contractual right to receive 700 in 2 years and has a market price of 566. All three assets are comparable with respect to risk, that is dispersion of possible payoffs and credit. You are required to measure the fair value of asset 1. To measure the fair value of asset 1 basis the above information. Okay. All right. Fine. Go through the question again and let me know what have you understood.
Sir, here the investment 1 has the 1 year period. Investment 2 and 3 is given. Investment 2 is 1 year. 3 is 2 years. So that we can take the value from that, I believe from 1 year comparable.
Yes. See, I have investment 1. At the end of 1 year, I am going to get 800 rupees. Okay. Investment 2, year 1, contractual right to receive 1200 at the end of year 1. And today the market price is 1083. Are we able to follow, girls? Yes. Leela, you are able to follow?
Yes, sir.
Investment 3, years 1 and 2. After that, you will get 700. Today, the market price is 566. So now they are asking, what is the market price of this investment? And you are given 2 comparables. Anybody has any doubts in the question so far? Anybody has any? No. Okay. Now, I'm not asking which one you can prefer. I'm asking, can I use investment 2 or investment 3 to arrive at the value for investment 1? See, I'm asking, can I use either of the two?
Yes, sir.
Technically, you can use either of the two. Yes. Investment 3, you will have to do discounting for 2 years. Investment 2, you will have to do discounting for 1 year. Yes or no?
Yes, sir.
Suppose the question did not give you investment 2 at all. It gave you investment 3. Could you still arrive at the value for investment 1? I will say answer is yes. I will say answer is yes. I can discount it for 2 years, find out the rate, apply that rate to investment 1 for 1 year and arrive at the value. So technically, wo investment 2 also I can use, investment 3 also I can use. But when both are given, now you tell me which investment option will you prefer? When both are given, which investment option will you prefer as a comparable?
Investment 2.
When both the options are given here, we will choose the option investment number 2,
Yes.
which
What
have 1
about?
year.
Okay. What about others? Leela, do you agree? Geeta, do you agree? Yes.
Yes. Yes.
So therefore, an investment whose value is 1083 today, after 1 year, it is becoming 1200. Yes or no? This is a simple compound interest formula. Okay. So therefore, 1 plus R is equal to 1200 divided by 1083. Right? So that gives you how much?
10.8.
10.8%. R is equal to 10.8%. Are we able to understand? Please calculate along with me. Leela, you are quiet today. Are you able to follow?
Yes, sir, I'm following.
Yes. All right. Fine. Okay. So 10.8% becomes your rate of interest. You just apply that discounting. Okay. So now I will apply 10.8% in discounting. So 800 into 1 by 1.108 raised to 1. It comes to rupees 722. So the value of the instrument today is 722. Is 722. Okay. Any doubts in this illustration? No doubts. Can we proceed further?
Sir,
Sanjay?
in this case, if you put 1083 divided by 1200 into 800, that case also it is coming 722, sir.
Which
Can we
one?
take, sir?
You are
In
doing
this,
just reverse calculation.
yeah,
That
that's
is
right.
800 is 1200. So 1200 is 1083. So
Yes,
for 800, how much?
yes.
That also you can do because this is 1 year. No problem.
Yeah. Okay,
No
sir.
issues. Okay. Absolutely fine. Okay. All right. Okay. So we move to the next one. An entity has estimated its next year earnings or cash flow based on certain probabilities as mentioned below. Possible cash flow, you have 3 possibilities given. You have the probability given. You have the probability weighted cash flows. 700 multiplied by 20% gives you 140. 800 multiplied by 40% gives you 320. 900 by 40% gives you 360. Yes. So now the question is, total expected cash flow 140 plus 320 plus 360. So that gives you 820. Risk-free rate is 6%. So present value of cash flow is 773. This is just hardly a calculation which is there. Tell me one thing. This is level 1, 2 or 3 inputs?
This is a level 3, sir.
Level 3. Because cash flow is an estimate. Discount rate is an estimate. Probability is an estimate. In fact, there is nothing which is clear here. Okay. Nothing which is observable. Everything is unobservable. Are we able to follow?
Yes.
Yes.
Risk-free rate is observable.
Which one?
Risk-free rate.
Risk-free rate. Sorry, I didn't see that. Risk-free rate is observable. Yeah. All right. Fine. So no doubts here. Example 16. So that takes care of it. So now we move on to the next one. ABC Limited acquires 5% equity shares of XYZ for 10 crores in the year X1, X2. The company is in the process of preparing its financial statements for the year X2, X3 and is assessing the fair value at a subsequent measurement date for the investment made in XYZ Limited. Okay. So now, based on the observable input, ABC Limited identified a similar nature of transaction in which PQR acquired 20% equity shares in XYZ Limited for rupees 60 crores. The price of such transaction was determined on the basis of comparable companies method EV/EBITDA multiple, which was 8. For the current year, EBITDA of XYZ is 40 crores. At the time of acquisition, the valuation was determined after considering 5% of liquidity discount and 5% of non-controlling stake discount. What will be the fair value of, sorry, yeah. What will be the fair value of ABC Limited's investment in XYZ as on the balance sheet date? Okay, fine. Okay. So this is a valuation question which is there, which is still there in your study material. So we just pick that up. There is a concept known as enterprise value. You people have studied this in AFM.
Yes, sir. Yes, as part of the business valuation. It's not
Yes.
yet come. It's not yet discussed.
Not yet discussed. Okay. So enterprise value is nothing but value of debt plus value of equity. Okay. Which is quite simple and quite logical. Okay. In absence of any information, so normally the premise that the institute has followed is, in absence of the information, the value of a company given in the question can be considered as its enterprise value. To find the value of equity, we can deduct the value of debt from the value of the firm or the enterprise. So value given is value of the enterprise. From there, you reduce your debt. So that gives you value of equity. Debt is usually interpreted as net debt, that is total debt minus cash and cash equivalents, based on the presumption that the cash and cash equivalents would be used to settle the debt immediately. Okay, so these are the assumptions or principles. So now basis this, we shall proceed to do the calculation. Okay, now the same question, let us understand. See. What has happened is ABC acquired 5% equity shares of XYZ. Okay. So I have, this is question 3. ABC Limited acquired 5% shares in XYZ Limited. Okay. I come here. Based on the observable input, ABC identified a similar nature of transaction in which PQR acquired 20% equity shares in XYZ Limited. Okay. PQR acquired 20% stake in XYZ Limited and ABC wants to take this as the observable input. Okay. This transaction it wants to take as the observable input. Now, the price of such transaction determined on the basis of EV/EBITDA multiple. So this price for this transaction was based on EV/EBITDA multiple, which is 8. Okay. For the current year, EBITDA of XYZ is 40 crores. Okay. So EBITDA 40 crores. And the valuation at the time of acquisition, the valuation was determined after considering 5% of liquidity discount and 5% of non-controlling interest stake discount. What will be the fair value of ABC Limited's investment? Have you understood this? Have you understood the question till now?
Yes.
Yes? All right. Now, see. EV/EBITDA is 8. EBITDA is 40 crores. Therefore, can I say that enterprise value is equal to 8 times EBITDA?
Yes, 320.
Yes.
So 8 into 40, this gives you 320. That is your enterprise value. Now, this enterprise value is for the entity as a whole. It is for the entity as a whole. ABC stake is how much? ABC stake is
5%.
5%. So I will multiply it by 5%, which comes to 16 crores. Any doubt so far? Any doubts so far? No doubts. Okay. Now, my stake of 5%, is it as significant as 20%?
No.
No.
No, sir.
A 20% stake will typically end up giving you a seat at the board. 5% में कुछ नहीं मिलेगा, right? So can I say that in this comparable transaction, PQR must have paid a premium? Yes. Can I say this?
Yes.
Because a
Yes,
20% stakeholder, nobody gets a 20%. See,
Yes, sir.
आपके typically in your corporates, 0 to 20%, or now you can, I mean, this is just benchmark, okay? 0 to 19%, you may face some resistance, but largely you can take the stake. You can largely take the stake, okay? 19 to 20%, this is a premium. Typically, okay? Why? Because 20% means you typically end up asking for a seat at the board. 20 to 49%, no problem. Okay, 20 to 49%, no problem. You will sail through without difficulty. 49 to 50.1%. This is where you command high premiums. Why? Because the moment you cross 50, you are the majority holder. You can run the way you want. Okay. Greater than 50%. Greater than 50%. Okay. Greater than 50.1%. Then it doesn't really matter. Okay. Then maybe, you know, that 2/3 special resolution, up to that 75%, you can have one more block. And then onwards, there is no reason to question. There is no reason to question the purchase. Chalta rahega, right? So now in this case, PQR has acquired 20% stake. So he must have paid a premium. That means my pricing, should it be more than that premium or less than that premium?
Yeah, more than the premium. He paid actually 20 crore
He
extra.
paid for 20%. I paid for 5%. So when I'm doing my valuation, taking his numbers as the base, should I add 5% premium or should I deduct 5% premium?
Yeah, we have to deduct it.
We will have to deduct it because I'm taking his valuation as the base. His valuation includes a premium. So I have to bring that down. I'll have to bring that down. Are we able to follow? Yes. So non-controlling interest discount 0.8. 0.8. And then there is something known as a liquidity discount, which they have given in the question. The valuation was determined after considering 5% of liquidity discount. After considering 5% of liquidity discount. So that 5% we take the liquidity discount. So your fair value of investments in XYZ becomes 14.4. So this is liquidity discount applied if the stake held is illiquid. It would be subjected to some lock-in restrictions or minimum period of investments. Non-controlling discount, the complete transaction. This one also I have explained. Are you having any doubts? Are you having any doubts?
No, sir. In the question also, it's a 5% stake. It's a 10 crore. Whereas
Yes.
20% stake is 60 crore, which means if it is a 20% in the 5 crore basis, 5% basis, it will come only the 40 crore, which means 20 crore they paid extra by
They
the
would
others,
have paid extra, yes.
which means that is a premium.
That could be the premium. Yes. Could be. But again, that would be if the investment is at or around the same time as ABC Limited. Right?
Yes, sir. There is a possibility to the step acquisition also slowly.
Whatever. Whatever. Yeah. Absolutely right. Okay. So any doubts here so far, girls?
So the premium is paid more than 5%, na?
In what sense?
10 crore, 5% paid in 10 crores. 60 crores divided by 4 is 15 crore. So 50%
एक मिनट
premium,
4 क्या है बेटा पहले ये बताओ.
20%.
Don't
PQR limited stake in 20%. So it's 4x
PQR is holding 20% for which
more
it has paid
60 crore.
60 crores. All right. So now what you are telling?
So if PQR of equivalent to 5% is equal to 15 crore.
अच्छा आप सीधा सीधा ऐसे proportionately कर रहे हो, correct?
So his premium is 50% paid. So why should deduct 5% premium
अच्छा तो अभी
from XYZ?
मैं वही कह रहा था कि ये चीजें proportionate नहीं होते. ओके आप टिपिकली जब आप एक्विजिशन करते हो, these percentages do not go on a linear fashion. जो 60 करोड़ का 20% वैल्यूएशन है और जो आप बिठा रहे हो 15 करोड़ 5% के लिए है, वो वैसे बैठेगा नहीं. बिकॉज रीजन बीइंग 60 करोड़ के मतलब 20% स्टेक के लिए यू एंड अप पेइंग अ हायर वैल्यू. उसमें इट्स नॉट जस्ट अबाउट getting a seat at the board. There may be a sentimental value also that gets attached, an intangible value. He's an NCI at so and so place. He's a significant shareholder of so and so company. So typically it does not work on the proportionate calculation basis. Okay. Now in our question, what we are having is we have been told that you use the enterprise value multiple. EV multiple in our case comes to 320 crores. 320 into 5%, it comes to 16. आप कह रहे हो proportionately it comes to 15. एंड 15 के ऊपर आप 5% का डिस्काउंट लगाइए, राइट? नाउ व्हाट वुड हैव हैपेंड इज, सी, PQR, when has it acquired stake in this company? Have they given the date? Have they given the date?
No.
नहीं. अभी for very simple discussions, okay, very simple discussions. Suppose कीजिए पेटीएम आईपीओ में आपने 20% स्टेक खरीदा. यस, यू हैड अप्लाइड फॉर अ 20% स्टेक प्री लिस्टिंग. आपको ज्यादा प्राइस पे मिला. यस, टुडे आई वांट टू बाय 5%. मैं कम दूंगा या ज्यादा दूंगा? कम, because today's market price is lower, right? So there was a pre-listing sentiment that was there for Paytm, which immediately crashed on listing of the IPO. And till now, the market prices have not reached the levels of pre-listing. Yes or no?
Yes.
Correct. तो उस reason से this 60 crores you would have paid a different value at the time of pre-listing. So I'm not sure at what point of time this valuation was done and how did he acquire. We are just going to be concerned that this is a comparable transaction. 60 crores ka valuation for 20%. You will determine your value based on the EV/EBITDA value. So what they have said is, they take this, the price of such transaction, that means this 20% 60 crore was determined on the basis of EV/EBITDA multiple. So the 60 crore kaise aaya? That was determined based on 8 rupees ka EBITDA multiple. So at that point of time, when they invested, EBITDA could have been XYZ rupees. EBITDA could have been XYZ rupees. I don't know. I can calculate, but I'm not interested to calculate. Okay. For me, this becomes your comparable number. For me, this becomes your comparable number. And this you will multiply with current year's EBITDA. Are you able to follow? Yes?
Yes.
Because उस टाइम पे क्या सेंटिमेंट चल रहा होगा, आई एम नॉट रियली कंसर्न्ड विद दैट. I am concerned with that EV/EBITDA multiple is my basis for calculation. Of course, I will not discount the fact that this is also another way for doing the calculation. I don't take it away from you. Okay. But in the question, they have specified what has to be used. आप उसे use करेंगे. अगर क्वेश्चन में दिया नहीं होता that you use EV/EBITDA multiple, if this particular line was missing, which one? If this particular line would not have been given, then what I would do? I would do the same thing that you told me to do. Is it okay?
Yes.
Yes. All right. Fine. Any doubts? Anybody? Leela, Geeta, Sanjay?
Clear.
Bibhu, clear? Yes. Swaminathan, clear? Yeah. All right. Fine. Okay. So that completes this question. All right. Next, we have free cash flows question. Okay. These look more like FM questions, okay? But it is just for making you comfortable, okay? To help you understand. UK Limited is in the process of acquisition of shares of PT Limited as part of business organization. The projected free cash flow of PT Limited for the next 5 years are as follows. Cash flows you are given for 5 years. Terminal value you are given. Weighted average cost of capital is 11%. Total debt is 1,465 crores. Surplus cash is 106.14 crores. Total number of shares is so much. Determine the value per share of PT Limited as per income approach. So what all you are given? You are given cash flows, correct? Coming to a terminal value of 3965. Discounting factor you are given. So arrive at present value of the enterprise less net debt. So that gives you value of equity. That gives you value of equity. Divided by number of equity shares, 8.53. So per equity share value, 204.83. Any doubts here? Straightforward calculation. Yes? You can
Yes,
go through it.
FM calculation, simple FM question.
हाँ वो
Similar
है.
to
Yes. Yeah, Swaminathan, you were telling something?
No, sir. It's easy only, sir. We studied this in EPS as well.
You would
EPS
have
also.
studied this in, I think, your intermediate also, if I am not wrong.
Yeah. Yes, sir.
Yes.
Intermediate also we studied in EPS and
Yes.
the security valuation
Correct.
and the business valuation.
So by large, DCF has been one of the most used methodology for evaluating particularly unlisted shares. In fact, it goes on to say that we have worked on some due diligence and valuations, and even private equity firms extensively use your discounting cash flow models. Their whole tenure of due diligence, which we had, about 4 to 6 months. So in that 4 to 6 months period, close to 4 to 5 months, while parallelly diligence was running as an activity, 4 to 5 months was spent only in analyzing the business, forecasting the profitability, preparing the next 7-8 years of cash flow, then determining the terminal value, seeing the growth that happens year on year to arrive at some trend. And then once they arrive at that trend, they will then determine the discount rate and determine the value today. And that value was used as the basis for conversion of your, for acquiring a stake. Then they put a premium because we are also giving a major stake to them. So to this value, a premium is assigned and then they get the stake. So this DCF method is by far one of the most widely used methods for valuations because it captures the earning potential of the firm. It captures the earning potential. बोल सकते हो sir, these numbers are all in the air. They don't really mean anything, but that is what it is. Because when you are committing, it's effectively you're committing to an enterprise that in year 2, in this case, you will get 187 crore. In year 3, you will get 121 crores. It's a commitment that is given. So therefore, this is what they will see when buying. And then every year after they have got the stake, they will evaluate performance and see why it is happening or why it is not happening. Are we able to follow? Yeah. So DCF has been one of the most favored methods for valuation of equity. Okay. All right. Right. So till now, any doubts? Anybody? No doubts? Shall we proceed further then?
Yes, sir.
All right. Fine. I think we're almost nearing the closure of the chapter. Yeah. Okay. Till now, I will just introduce this topic till 9 and then I'll give a break for about 10-15 minutes before we continue. Okay. Applying fair value rules to liabilities and own equity. Till now, whatever we have studied, it was from the perspective of an asset. Yes or no? Yes.
Yes, sir.
Why did we take an asset? Because this is easiest to correlate. आप asset का movement, sale of an asset, you can visualize it very clearly. You can understand it very clearly. But do I do only fair valuation of assets? Answer is no. Financial liabilities need to be presented at fair value. So therefore, even liabilities and even equity is fair value. Even equity is fair valued. Yes, for example, in business combination, when you give issue own equity, that has to go at fair value. So even for liabilities or equity, you will have to apply fair valuation principles, and the same rules will continue. Same set of rules will continue. Okay. What are those rules? The liabilities and or equity instruments will remain outstanding on the date of measurement. This is clear. Standard prescribes to use all observable inputs, what we saw for assets also, if quoted prices are not available, and should minimize any unobservable inputs. The transaction considered to find fair value should be evaluated in line with an orderly transaction. In line with an orderly transaction. Okay, so not entity specific. Ind AS 113 provides specific guidance on the respective scenarios while evaluating fair values of liabilities and own equity instrument in case direct quoted prices are not available. Okay, all right, fine. See, I was talking yesterday, in the last class, that fair value is the price received to sell an asset or paid to transfer a liability. So paid to transfer a liability. What does it mean? For example, bank holds a debt obligation with a face value of rupees 1 lakh and a market value of rupees 95,000. Assume that market interest rates are consistent with the amount in the note. However, there is rupees 5,000 discount due to market concerns about the risk of non-performance by counterparty 1. Okay, so what they will do is counterparty 1 would be required to pay the face value of the note to settle the obligation, because the bank might not be willing to discount the note by the market discount rate or the credit risk adjustment. Therefore, settlement value would equal the face value of the note. Are we able to understand this? Yes, you are able to understand what is settlement value and what is settlement value? Yeah. Transfer value, counterparty 1 must construct a hypothetical transaction in which another counterparty with a similar credit profile is seeking financing on terms that are substantially the same as the note. Counterparty it too could choose to enter into a new note agreement or receive the existing note from counterparty 1 in a transfer transaction. In this hypothetical transaction, two should be equally willing to obtain financing through a new bank note to justify the return for a payment of rupees 95,000. Therefore, transfer value would be 95,000 and thus the fair. So what they are saying is you have a debt obligation of 1 lakh. Fair value is from the perspective to transfer this debt to somebody else. That transferring the debt to somebody else, you will have to pay 95,000 rupees. You cannot look at you cannot look at the maturity value, because maturity value extinguishes the instrument. You are not interested in extinguishing the instrument. You are interested in keeping that instrument alive. So for that keeping alive, you will typically take it with the 95,000 that you will pay to keep the note alive. Are we able to follow? Yes.
Yes, sir.
Others, Leela, Manish, Bibhu,
Yes,
Sanjay. Yes, all right. Okay. So that's plain and simple. All right. So we take a break. We shall convene at 9:10. Okay, it's around 8:55 right now. So 9:10 we shall convene and we shall try to close up this particular standard by about 9:40, 9:45. Okay, all right, fine. Break, please. valuation rules to liabilities and own equity. How do I do that? Okay, so now that would come across as two cases. One is my liabilities, which I have issued, or my equity, which I have issued. They are held by other parties as assets. So suppose I issue debentures. That means somebody has purchased those debentures. So it is a liability for me. It is an asset for the counterparty. I issue equity shares. For Reliance, it becomes equity. For me, it becomes an asset. So when I have to do a fair valuation of instruments which are held by other parties as assets, how do I do that? If when a quoted price for transfer of an identical or similar liability is not available, an entity shall measure fair value of the liability from the perspective of a market participants that holds the identical item as an asset at the measurement date. Okay. So quoted price for transfer of identical or a similar liability is not available. That means my liability, there is no quoted price for the liability. There is no quoted price for the liability or for my entity's own equity instrument. There is no quoted price. Then the quoted price that I can take is the quoted price from the perspective of the asset holder, from the perspective of the asset holder, the market participant who holds the identical item as an asset at the measurement date. Are we able to follow? Are we able to follow?
Yes, sir.
So why do we say identical? The same item will be held by as an asset by another person. Then we can
Correct.
measure.
So same item means identical, na? Sanjay?
Yes.
Same item means identical, na? The identical item as an asset. I mean, anything I'm missing out?
No, I'm not saying identical is some other asset. My liability as an asset will be an asset to another person.
Correct.
Why
So
not value
suppose
on that asset?
I have issued Series A debentures. Okay. Somebody else will hold the same Series A debentures which I have issued as an asset, right?
Yes, right.
Same thing. So this only will be the asset. When they
Okay,
say
then,
identical, they mean the same thing. Okay.
okay.
So identical is exactly the same. It is my counterparty. Okay. So that is what they mean by it. So when you talk about identical, that holds this identical item as an asset at the measurement date, then preference one, you can use the quoted price for the identical item held by another party as an asset if available. So my liability is an asset for somebody else. That asset is traded on the market and there is a price for that. So that price will become fair value for the asset and I will take it as fair value for the liability also. Are we able to follow? Yes.
Yes.
If quoted prices are not available, you can use such other observable inputs such as quoted price in a market not active for identical items held by another party as an asset. Okay, so we can go for non-active markets. Okay, that is basically your level 2 inputs. And if level 1 and level 2 inputs are also there, then use a valuation technique such as income or market approach. You go for level 3. Are we okay with this? Are we okay with this?
Yes.
Yes. It is basically they are saying follow the hierarchy. Go for level 1 inputs first. Level 1 nahi hai to come to level 2. Level 2 nahi hai to come to level 3 inputs. Okay. All right. Sometimes it may happen that my liability will not be an asset for the counterparty. Example, decommissioning liabilities, provision for expenses, etc. Yes or no?
Yes, sir. Decommissioning as per the NDS 16.
Correct.
The plant and property. Yeah.
Yes. So everybody understood this, right? Many times what happens, my liability need not be an asset for somebody else. Yes or no?
Yes.
Yes,
It
sir.
is quite common, okay?
And the decommissioning, we don't know the party to whom we will do that.
Yes, obviously. Decommissioning is just one example. Any provision that we take, provision for expenses,
For warranty, like
warranty, yeah.
employee benefits.
Correct. We don't know who is the counterparty. So therefore, it will be my liability, but it will not be an asset for somebody else. So therefore, in that case, can I get quoted prices? Answer is no, because my liability is not an asset, it is not quoted. So therefore, you will have to measure using a valuation technique. Are we okay with this? Yes?
Yes.
Girls, Leela, Geeta, did you follow? Yeah?
Clear, sir.
Okay, followed. Geeta, did you follow?
So,
Okay. Bibhu, ठीक है?
हाँ सर ठीक है.
Okay. So, if my liability is an asset, quoted price or level 2 or level 3. If my liability is not an asset, I will have to take a valuation technique methodology from the perspective of a market participant that owes the liability. Owes ka matlab who has to pay the liability, okay, or has issued the claim on equity. Okay, so this is a very simple way of applying the fair valuation rules. Now there are some principles. When I have to do the fair valuation of a liability, you will assume transfer. You will not assume settlement because आपका liability is not getting closed. It is only moving from one hand to the other. So assume a transfer and not a settlement. Is there a quoted price? If your liability is quoted, then please use that quoted price. Liability getting quoted. I'm not saying liability as an asset getting quoted. There are two different things. Liability is directly quoted. Many times what can happen? You are aware that bonds has a market for investors. Yes or no? Bonds has a market for investors. Today, suppose you want to subscribe to debentures of Tata Capital. You go to the stock exchange, you log into your demat account, you select your Tata Capital debentures, you can buy. This is a market for assets, which are bonds. Many times what could happen in some advanced markets, liabilities could have a market. I issued debentures. Now, suppose Sanjay is in need of money. So Sanjay will go on to the market and he will see whether there is any availability of funds through the bond market. I want to give up my liability because I have adequate money right now. Maturity period is still far away, but I want to come out of this liability. So there is a quoted market for this liability, where if I agree to pay, Sanjay will take the liability based on the price that is quoted in the market. So when there is a quoted price for the liability, please use that. If there is no quoted price, is it held as an asset by another party? Yes. If yes, then use the fair value of identical asset. Adjust quoted price only if factors specific to the asset but not to liability or own equity are present. If it is not an asset, it is not quoted, then you will have to use the valuation technique. Are we able to follow this?
Yes.
Yes. All right, fine. Now, when we talk about fair valuing a liability, the critical factor which is there in a liability is fulfillment of the obligation. So there is always a risk of non-performance. There is always a risk for non-performance. For transfer restrictions of liabilities, you don't have to do any separate adjustment. You don't have to do any adjustment. Okay. Your fair value of liability will be different for somebody having a triple A rating, will be different for somebody having a triple B rating. Yes or no? Today, if you have to give money to a triple A rated company like, let us assume you have to give money to a triple A rated company like Tata Capital. You will give it, say, for 1,000 rupees. But suppose I come out with a debenture listing for my company and I come to you for asking for the money. Will you give me 1,000 rupees? Answer is no. You will say, sir, we don't know you. You are not as reliable as Tata Capital. So we will give you the money, but we will give you 1,200 rupees and not 1,000 rupees because your credit rating is not as high as Tata Capital. Are we able to follow? Yes.
Yes, sir.
So
Yes,
that
sir.
1,000 and 1,200 both are fair values, but 1,000 for Tata factors the stability that it has. 1,200 for me factors the lack of stability compared to Tata that is there in my product. Are we able to follow? Similarly, if you put money on a fixed deposit, today banks like HDFC or ICICI give you fixed deposit rates at around 6.4 to 6.7%. In that range, they give you. Yes Bank offers you rates between 7.5 to 7.7%. What is so different between HDFC and what is so different between Yes Bank? What is so different?
Credibility.
Yes, credibility. It is all about credibility. Or stability, right? Or stability, or rather the composition of assets that the banks have. Okay. So that gets factored in the rating. That gets factored in the rating. Okay. So fair value of liability reflects a non-performance risk. It gets visible depending on the rating that you have. Financial liability with demand feature. Many times what happens, you have liabilities which are payable on demand, So fair value is not lower than the amount payable on demand, discounted from the first date that the amount could be required to be paid. So on demand payment, you cannot show it lower than what is the amount that could be demanded. You will discount from the first date the liability can actually be paid. Are we able to follow? Yes.
This last one, financial liability with demand feature, I could not understand.
Okay, fine. See, I have a cash credit facility. Yes. आपको पता है what is a cash credit facility?
Yes.
Yes, a cash credit facility is basically you draw money from the bank. It is like you are running bank account with a negative balance, with an unfavorable balance.
Like an
Now,
overdraft.
yeah, CC or overdraft. Now, CC or overdraft जो होता है, these typically are facilities which are payable on demand. On demand. Okay. They stretch as if it is your bank account because all your trade receivables money flows in that. You pay suppliers out of that. They are just plugging in the working capital gap that you have from your operations. So your cash credit account is nothing but on demand loan. Do you agree?
Yes,
Yes.
yes. Yeah,
Tomorrow,
there's
if you default, if you don't service the interest, if you don't give the stock statement, ऐसे कुछ repeated defaults होते हैं, then you have to pay the full amount. You will get a notice from the bank. Now, on-demand loan means what? You will have to pay the outstanding balance. That becomes the fair value. Your fair value cannot be lower than the outstanding balance. So suppose on-demand loan, let us suppose this balance is 1.5 crores. This is the balance. Your fair value cannot be less than this. It cannot be less than this. So fair value not less than the amount payable on demand. Are we able to understand?
Yes, now clear. Yeah.
But suppose I come to the bank and say, I cannot pay this immediately. On demand, I agree, but I'll pay after 1.5 years, 2 years, over a 2-year period. Then you can go in for a discounted approach. You can go in for a discount. Are we okay? Yes?
Yes, yes.
All right, fine. Based on the credit rating, this small example is there. X and Y each enter into a contractual obligation to pay 500 rupees in cash to D in 5 years. X has a AA credit rating and can borrow at 6%. So X is like Tata Capital. Y has a BBB credit rating. It is something like me and can borrow at 12%. This is again like HDFC Bank and Yes Bank example which I gave. So if you are promised 500 rupees after 5 years at 6%, today you will invest 374 rupees. So in X company, after 5 years, if you are promised 500, today you will invest 374 rupees. This is the present value. In the case of Y, suppose you are promised 500 after 5 years. Today you will invest only 284. Today you will invest only 284 because Y is not so stable as X. It gets priced in the fair value. This is the fair value of the liability. Are we able to follow? Yes?
Yes, sir. It's totally based on the creditability.
This is an example of the credibility. Yes? Everybody understood, right? Manish?
Yes, sir.
In case of Y, we are investing only 284 and we'll get
Yeah.
500.
You
So-
are investing 284, getting 500. Don't think that it is a better instrument.
That's what I'm thinking. Because
No, it is not a better instrument. Why are you getting a higher rate of interest?
Because of the credit risk. More
Because
risk.
of the credit risk, right? See,
More
you
risk, more return.
you get more return because there is more risk involved.
risk is
Sanjay?
higher. Yes, risk is
Risk
higher.
is higher. That is why you are putting less and getting the same amount. Okay?
Yes.
Is it fine? Yeah. So that is how credit risk or your performance, non-performance risk gets factored in the fair value of the instrument. So for X, the fair value is 374. For Y, the fair value is 284. Okay. All right. So that covers this part. All right. Now, applying fair value rules to financial assets and liabilities with offsetting positions in market risk or counterparty credit risk. There is a measurement exception that is there, which is involving financial assets and liabilities with offsetting positions. I can net set the positions. For example, I have trade receivables in dollars. I have liabilities also in dollars. So I have one side trade payable, one side trade receivable, both in dollars. Now, when I have to do a fair valuation in such cases, I can either do gross basis, I can either go 1 minute. Yeah, I have trade receivables. Trade receivables also end up getting fair valued. Trade payables also end up getting fair valued. So now, suppose I have an asset and a liability denominated in foreign currency. I have an option to do separate fair valuations for a receivable as well as for a payable. This is the regular form what you have been studying since the last class as well as the current class. But if a net setting is possible, you can also go for fair valuation of the net open position. For the net open position. So for example, you can do the fair valuation on a net basis for price receivable to sell the net long position or the price payable to transfer the net short position. Okay, there is a sell position. To transfer that sell position, how much you will pay is something that you will have to, you can fair value. Or there is a net receivable position. So how much you will have to pay, you can do it on a net basis. What is required is a risk management or investment strategy, information about KMPs, and fair value at the end of each reporting period. Offsetting, this is possible only where other market participants also manage the similar risk on a net basis. If this is an industry practice, you can do that. There should ideally be same information and market practice available for making these assets or liabilities on net basis. Once the exception to certain fair value certain assets or liabilities on net basis is being used, unit of account would be considered as net. You would consider asset minus liability net as one single unit of account. Market risk should be same while combining any asset or liability. Example, interest rate risk cannot be netted with commodity price risk. Duration of a market risk should be identical to use the exception for valuing assets or liabilities on net basis. Okay, so for example, interest rate swap of longer period will only be allowed to value at net basis up to the duration of financial instrument of the same duration. So basically, it is a very, very specific net setting or offsetting that you are allowed. Other industry players also should do on the same basis. And your tenure of instruments for the receivable and payable, the tenure should be the same. You cannot have one tenure very high, one tenure very low, and then say that I'm going to do net setting, because there will be a period where a net setting will not work in such cases. Are we okay with this? This is only theoretical nature of discussion, nothing much on a practical front. Most of it is common sense. Is it okay?
Yes.
If you have any doubts, do let me know. I will be addressing. Else we can proceed further. We'll proceed further. Girls?
Yes, sir.
All right, fine. Fair value at initial recognition. Very important. See, till today, I have always been telling that your fair value is an exit price. Yes or no? Yes,
Yes.
or no?
Yes.
Price receivable to sell an asset or payable to transfer a liability. You are coming out of the asset or liability. Correct? Now, if I am coming out, if it is an exit for me, it is an entry price for somebody else.
Yes.
Yes or no?
Yes.
If I am selling the asset, somebody is buying the same asset. Yes.
Yes.
So in normal situations, exit price is equal to entry price is equal to fair value. Yes? Normal cases. Exit equals entry equals fair value. Yes or no?
Yes, sir.
Yes, sir.
For example, you go to take loan from a bank, right? Market rate of interest is say 9.5%. The bank will offer the same rate to you, 9.5%. If it is a woman, some banks offer a 0.25%, some small discount they give, but it is essentially as per market rates. So bank has given an asset to you in the form of loans given. You will recognize the same liability at the value which bank has given. Yes or no?
Yes.
Yes or no? So for the bank, it has given the loan, you have taken the loan, you are entering into this transaction. Now, suppose that bank wants to, or suppose you want to transfer the loan from, let us say, X bank to Y bank. You are not you are not extinguishing the liability, you are transferring the liability from one side to another side. Yes or no? You are transferring the loan from one bank to another bank. So
Yes.
that also would happen at your fair value. That also would happen at your fair value. Are we okay with this?
Yes.
Yes. Unrelated party, there is absolutely no problem. You can say that fair value is an exit price. It also becomes an entry price. But there are four special cases. There are four special cases where your entry and exit prices will not be the same. Okay. First case, transaction with related parties. Unless it is at arm's length, it will be at it will be treated as if it is not at arm's length. Okay. Under duress or seller forced. So suppose you are under pressure to sell, then it will not be at what you can say, it will not be at fair value. Entry price will not be equal to exit price. Different unit of account. This is very common. How many of you have handled acquisitions or slump sale purchases? Anybody has seen the slump sale? In income tax hota hai na slump sale. Anybody has seen?
Yes, sir.
Practically.
No, sir.
Okay, fine. See, what happens is, suppose I work in a place which is into hotels and real estate division. Okay. Now, I want to sell my hotels division. So, I will identify all assets, all liabilities, everything I will identify relating to hotels division. I will assign a single value, rupees, let us say 25 crores. 25 crores worth of hotel division, I am selling it out. My job is over. Now, the recipient of this, the recipient of the hotel division, how do you think he will account for it? Will he account as a single line item, hotel division account debit to bank 25 crore? Yeah.
No, he will account for asset by asset liabilities.
He has to do it asset by asset. Yes or no, boys and girls? He will show property, plant, equipment, debtors, creditors, loans, etc., etc. He will show separately. Yes or no?
Yes, sir. Yes.
So when he
Yes, sir.
shows separately, what is the basis? What is the basis? सर वो फोन करके पूछेगा, जो बेच रहा है ना उसको फोन करके पूछेगा आपका property plant equipment kitna hai, debtors kitna hai, creditors kitna hai. Will he actually do that? He
No,
can't do
no.
that, right? You can't expect him to call the seller and say, give me the breakup of this. Because the moment he asks that, then it does not become a slump sale. The moment you assign exact values as per the transfer, as what it was in the books of the seller, it does not become a slump sale, right? It will start attracting GST. Slump sale doesn't attract GST. So 25 crores split, they will do a fair valuation of this. They will do a fair valuation of all these items. They call it something as PPA, purchase price allocation. You call upon valuers, they will do the calculation of fair values and they will give something known as a purchase price allocation report. Basis that purchase price allocation report, we take entries in the financials. Are we okay with this?
Yes, sir. Thank you.
So, logical fallout now. Will this 25 crores be equal to the fair valuation that you do?
No.
No.
No, sir.
It won't be. That is why it is an exit price for the seller. It is an entry price for the buyer. But because of different units of account, for the seller, it is one division. For the buyer, it is multiple assets. Different units of account will give difference in the exit price and entry price. The difference would go into your goodwill or capital reserve, whatever it is. Are we able to understand this? Yes.
Yes,
Yes.
sir. Thank
Yes.
you.
All right. So related parties, obviously. Under duress, obviously. Different units of account, obviously. Transactions not on principal or most advantageous market. ये तो सर definition में ही लिखा है. Fair value is transactions between market participants in the appropriate market. And appropriate market is which market? Either it is principal market or most advantageous market. If you sell in any other market, how can it be your fair value? When definition wants you, because when you sell in any other market, you are not doing the business rationally. You are not doing the business rationally. Yes or no? Correct.
Yes.
All right. So that is how it is. So when that is the case, in all these four cases, 1, 2, 3, 4, transaction price will be different, fair value will be different. On entry, I am actually paying some amount. In this case, I am actually paying 25 crores, right? But I'm accounting, let us assume, fair value of 30 crores. I'm accounting, let us assume, fair value of 30 crores. That means what? There is a gap of 5 crores. There is a gap of 5 crores. That 5 crores is what we call as day one profit. On entry into the asset or liability, this becomes your day one profit. This becomes your day one profit. Recognize in P&L if you cannot attribute it to transaction cost. Of course, other standards will tell you if it is a business combination, it will go in goodwill or capital reserve, XYZ, etc., etc. But the key point is recognize it in the P&L if you cannot attribute it to transaction cost. Are we okay with this? Yes.
Yes, sir. In this case, we will say in the business combination, it's a bargain purchase bargain.
Correct. Yeah. Girls, did you follow?
Yes, sir.
All right, fine. So fair value at initial recognition. This RTP, you people have studied Ind AS 41 agriculture.
Yes.
So you can go through this for homework. Okay. This is based on Ind AS 41. I put it here because it has something to do with fair value. Because under Ind AS 41, You value it at fair value less cost to sell, right? So that is why this is placed here. All right. And now we come to the last question, which is a culmination of the last 2-3 things that we have done. Okay. And that kind of, culminates in our understanding. Okay. So, Rohit, I hope these two materials you people have downloaded. I hope you have downloaded the materials.
Yes,
Okay.
downloaded.
Rohini, a listed company, owns an asset that is traded in different markets, which has to be valued at fair value under Ind AS. Rohini currently only buys and sells the asset in Maharashtra market. The information relating to the asset is as under. You have volume of the market in units, Kerala, Rajasthan, Maharashtra, price, cost of entering the market and transaction cost. Additionally, Rohini acquired an entity on 31st March 20x2 and is required to fair value a decommissioning liability. The entity has to decommission a mine at the end of its useful life, which is in 3 years' time. Rohini has determined that it will use a valuation technique to measure the fair value of the liability. If Rohini is allowed to transfer the liability to another market participant, the following data would be used. Labor and material cost 14 crores, overheads 30% of labor and material cost, third party markup industry average 20%, entities non-performance risk 2%, annual inflation rate 5%, risk adjustment cash flow uncertainty 6%, risk-free rate of government bond 4%. Discuss with relevant computations how Rohini should measure the fair value of asset and liability under Ind AS 113. Tell me one thing. Which appears to be the principal market from the given data? This part.
Maharashtra, sir.
Market, sir.
Why Maharashtra? What is the definition of principal market, beta?
Kerala, sir. Kerala.
Kerala, no? Yes or no? Highest
Yes.
number of transaction happens in Kerala. Maharashtra is where it is operating. So this is the 11201540. Cost of entering the market 140, 140. Maharashtra, will you take 210? Answer is no, because you're already operating in Maharashtra. Yes or no?
Transaction cost, yes.
Yes, sir.
So no cost for Maharashtra. So this is your potential fair value. Transaction cost you subtract. So 1120, 840 and 1400. Are we okay with this? Net proceeds? Yes. So Rohini already operating Maharashtra market, therefore cost of entering will not be incurred. Fair value not adjusted for transaction cost. As per Ind AS 113, these costs are not a feature of asset or liability, but instead may be considered while determining the most advantageous market. Kerala market is the principal market since it is the market with greatest volume and level of activity. Based on the Kerala market, fair value will be how much? 1190.
190.
Yes. Ignoring transaction cost. Ignoring transaction cost. If information about Kerala market is not available or you cannot access this market, fair value must be assessed using price in the most advantageous market. The market that maximizes net proceeds that would be received to sell the asset after considering both transaction cost and usually cost of entry. Most advantageous market is therefore the Maharashtra market. As explained above, costs of entry are not relevant here, and therefore based on this market, the fair value would be 1540. Assume that market participants are independent and able and willing to enter into transaction. Are we okay with this?
Yes.
Yes.
For best estimate, the market is महाराष्ट्र
किसके लिए?
बेस्ट estimate, best adjusted.
Most
Because we have
advantageous.
the value for Rajasthan, most
Most
advantageous.
advantageous is obviously Maharashtra. Yes, absolutely right. लेकिन अगर प्रिंसिपल मार्केट है, you don't even look at the most advantageous market. Don't forget that. Okay.
Yes, sir.
प्रिंसिपल मार्केट है, इसीलिए एडवांटेजियस कितना भी हो, डोंट गो टू दैट. ओके, ऑलराइट, फाइन. नेक्स्ट, you have a decommissioning liability which is given to you. Okay, this is just a mathematical calculation. Okay, nothing major. You can see total labor and material cost is 14 crores. Labor and material cost 14 crores. Overheads at 30% of labor and material cost 4.2. So 18.2 crores. Next, third party industry average. Third party industry average 20%. So 18.2 into 20%, 3.64 crores. So that gives 21.84 crores. Any doubt so far?
Clear.
Clear. Then I have a discounting rate. Annual inflation rate of 5%. Annual inflation rate of 5%. 21.84 into 1.05 raised to 3 because it is future. So 25, 28, 25, 300. Risk adjustment, cash flow uncertainty, 25.28 into 6%. 25.28 into 6%. Discount at risk-free rate plus entity's non-performance risk. 26, 79, 94, 818. This number divided by non-performance risk 2%, risk-free rate of bonds 4%. 4 plus 2, 6. Are we able to understand? Yes?
Sir, I have a doubt that we have calculated the inflation adjusted total price. Then why we less the cash flow uncertainty? We should less it, no?
कैश फ्लो अनसर्टेनिटी और इन्फ्लेशन दो अलग अलग चीजें हैं.
No,
कैश
sir.
फ्लो अनसर्टेनिटी इज लाइक अ कंटिंजेंसी. इट इज लाइक सेइंग ठीक है, इन्फ्लेशन तो मेरा हो रहा है 25.28. कैश फ्लो अनसर्टेनिटी इसके अलावा भी हो सकता है. आई मे एंड अप स्पेंडिंग मोर लाइक अ कंटिंजेंसी. दैट इज व्हाई इट गेट्स एडेड.
Yes, sir. I think it's the from the above amount, so we should exclude it, means deducted.
किस मतलब 25 करोड़ से आप 1.5 घटाना चाहते हो?
I think, sir, that it's included in inflation adjusted price. The
No,
cash
no, no. नहीं, नहीं, नहीं. See what happens. Cash flow uncertainty is a risk. Inflation is not a risk.
now,
So
sir,
what
other than that,
so what happens is cash flow is over and above your inflation and uncertain. So that is like 14 plus 30% plus 20% markup. This is a conservative estimate of your operating costs. But थोड़ा सा अगर चेंज हो गया तो इसके लिए you put it as a contingency cost, as a contingency cost. Okay, तो ऐड करना पड़ेगा. ठीक है. Anybody else? Any doubts? Manish, Swaminathan,
Yes, sir. Perfect, sir.
all perfect. Okay, girls, Geeta, Leela, all clear?
Yes, sir.
Clear.
Okay, fine. So that concludes this. And with that, we kind of conclude the chapter. Let me just pull out some MCQs. Where was I last time? Just a sec.
Hello, sir.
Yes.
Meanwhile, I just want to address for 1 minute to our students.
Yes,
Then,
madam, please.
sir, students, I hope you are those who are going to attempt for January 2026 examination. They are going through the LVRC classes also, and we got some feedback. We'll definitely take care of those feedbacks. My request was that in case any student is, you can go through the LVRC schedule, and in case you find that any particular standard which we have not covered, and you are interested to take that LVRC session also, just let us know so that we can schedule it. Okay, what as of now, what we have planned is that what are the important standards for those we have scheduled the LVRC class, revisionary classes. But there are some standards which are missing. In case you are interested for those standards also, just let us know. We'll see how we can do it. And please do fill the feedback form. Okay. Thank you. Sir, you can continue with the MCQs.
Yeah. Question 7. Changes in the valuation technique. What is it? Is it change in accounting policy? Change in accounting estimate? Prior period error? Or change in valuation technique is not permitted? Question 7.
Change in accounting estimate, sir.
Change. Others? Yes?
Yes, change in accounting estimate.
Yes,
Okay.
sir. Estimate, yes.
All clear? Okay. All right. Question 8. Tyson Limited has invested in certain bonds. Okay. The fair value of these bonds in different markets to which Tyson has access is given to you as under. Principal market 50,000. Highest and best use 60,000. Net present value method using Gordon's formula 55,000. Asset based valuation approach 45,000. Which one will you use? Slightly
net present value.
question, but don't forget the principles.
I think net present value.
Again, I'm saying, don't forget the fundamental principles of fair valuation. Okay, they have just slightly twisted the question and given.
Then principal market.
You will have to use the principal market value. This is basically, they are saying principal market becomes your quoted market price. Okay. They have not used the term quoted. They have used the term principal market. You can take that as your fair value. Okay. That is why, because we tend to get a little confused because we see bonds and then we start thinking how can bond have a principal market or highest and best use, etc., etc. But anyways, option B, that is highest and best use, that is quite inconsistent actually. But A, option 1, option 3, option 4, all of them seem okay, but you will follow the principal market value. Is it okay? Yes. All right, fine. Question 10. When an asset is acquired or a liability is assumed in an exchange transaction, asset के बदले में asset, liability के बदले में liability, like that. The price paid to acquire the asset or received to assume the liability, is this fair value, transaction price, purchase price, or settlement price? What is it? Go on eliminating. You don't settle liabilities, so it cannot be a settlement price. Right? So then you are left with 3 options: fair value, transaction price, and purchase price. Fair value hoga if those conditions are met. Okay. Those 4 conditions are not there. So we ignore that for the time being. You are left with purchase price and a transaction price. This becomes a transaction price because you are actually not buying something. You are also giving up something. So you are getting something and you are giving up something. So these two together is nothing but a transaction you're entering into. It becomes a transaction price. Is it okay?
Yes.
Question 11. Question 11.
So fair value of liability is measured using the quoted price of the identical item, trade, and the asset in an active market, and the price needs to be adjusted for factors specific to the item or the asset.
What about the others? Do you agree with Swaminathan? Girls?
That's answer two, I think.
Answer 2. Quoted price in an active market does not represent fair value at the measurement date. Okay. See, today's discussion only. Level 1 prices. Did we adjust at any point of time?
No,
No.
we will not adjust anything.
Only one case we adjusted. That example we saw of the clinical trials getting failed, or in our case, Tata Advanced Systems getting an Airbus order. In that case, what did we do? We have done an adjustment by taking 1st April price. Do you remember or not?
Yes.
So, in this case, can I say that quoted price does not represent fair value? Answer is no. Quoted price at 3:30 p.m. did represent a fair value, but you got additional information. So therefore, there is a specific factor that requires adjustment to the quoted price, which is the event that occurred after the trade closure. Yes or no?
Yes.
Geeta, Leela, did you follow?
Yes, sir.
Yes. So therefore, answer number 3 falls in place, right? Answer number 3 falls in place. But at the same time, active market not readily accessible for individual assets or liabilities. What do you think? Is it possible that an active market will not be accessible for individual assets?
It's not
It could
possible, sir.
happen. It could happen. It's quite common. You could have a case where you are unable to access the market for whatever reasons. Then there is a quoted price, but can you take that quoted price? Can you take that quoted price? Yeah. When you are unable to access a market, can we take that quoted price? Answer is no.
No, we will do
Because
some
your
adjustment.
asset is not saleable only in that place. So there is a quoted price. It is a level 1 input, but because you are unable to access it, it becomes irrelevant for us. We will have to do an adjustment to the quoted price. Number B, second option, quoted price in an active market does not represent fair value at the measurement date. In what circumstances can this be possible? Rare circumstances, but when there is cartelization involved. You know what is cartelization?
Reduction.
Yes.
People come together to influence the prices. Okay. So that will go beyond your fair value because they are rigging the prices. So in all these 3 cases, your fair values from the marketplace, can you take them as it is?
No.
Answer is no. So in all the 3 cases, you will have to do an adjustment to the fair value. So 4th option, all of the above becomes correct, right? Okay.
Right. All need adjustment.
Yeah. Question 12. Which is the answer? Very simple. 2 सेकंड लगेंगे आंसर देने में.
Income approach.
Income is prescribed there.
The income is market also prescribed.
Net present value approach.
Yes. Net present
Cost also
value
prescribed.
approach is not prescribed.
Yes, NPV.
Absolutely right. NPV, nowhere it is prescribed. We use NPV commonly, but NPV as such is not prescribed in the standard. Answer 3 is right. Sanjay, you're able to follow? Manish?
Yes.
Yes? All right.
Yes, sir.
Question number 13. Bibhu is there, right? Yeah. Question number 13. Quick. Last
Sir,
2 questions.
sir, little bit up, sir. My window is
Oh.
not clear. Yeah.
What is happening is 1 second. Let me just. I am unable to scroll it. This is an Excel file which I have opened as it is. Still, it is not visible.
Visible, sir.
Okay. Yeah. Question number 13. What is the objective of Ind AS 113? What is the answer?
Valuation technique.
Valuation techniques used.
Users will assess valuation techniques and inputs also now. And effect of measurement, day 1 profit or loss, or for unobservable inputs used for recurring fair value measurement, effect on the P&L. All these 3 will be assessed by the user of financial statements. So all of the above. This is the objective. Are we okay? Yes. Question number 14. Highest priority to which one? Lowest priority to which one? In that order.
Fourth one, sir.
Fourth one. Highest priority to quoted prices, lowest priority to unobservable inputs. Absolutely right. And last question, question 15. What is the rule? Golden rule.
Last one, sir.
Last one. Yes. Last one is your golden rule. Okay. All right. So I think with that, we conclude the chapter Ind AS 113 that deals with the fair value measurement. So hope it was okay, all of you. Any doubts, please let me know. All right.
Clear. Thank you.
Clear? Okay then. See you guys. Thanks everyone.
Thank you, sir.
All the
Thank you so,
best.
thank you so much, sir.
Thanks. Thank you. The session concluded.
Thank you, sir.
Yes. Thanks.